The time has come, said Jerome Powell at his Jackson Hole speech on Friday, to confirm that the Fed will cut the interest rates at the September meeting, but he didn't say much on the size of that upcoming interest rate cut. The data will decide, he said. So all eyes are on the data. Now, welcome to the new week of Trading with Swissquote's Daily Market Talk. So the time has come, guys. This is what Jerome Powell said at his Friday's Jackson Hole speech in front of the entire world and in front of the entire investment community, who were obviously waiting for hints to assess what to expect next for, well, the FOMC's September meeting. The time has come for policy to adjust, and the direction of the travel is clear. This is what he said. Now, we knew that the time had come, obviously, and no one had any doubt about the direction of the travel. But what made the whole speech of Friday dovish is, well, this reluctance to give any guidance regarding the size of the coming interest rate cuts from the Fed, knowing that there has been a fair amount of speculation out there for at least one jumbo rate cut in the last 3 FOMC meetings of the year. Instead, Jerome Powell kept the door open for a large interest rate cut bets. The pace of rate cuts will depend on the incoming economic data, the evolving outlook, and the balance of risks, the Powell said. And well, Chicago Fed's governor, Mr. Gosby, also said that it is time now to pay more attention to the employment side of the market, making it clear for everyone that as the inflation in the US, well, seems to be under control now, the developments that we will see in the employment leg of the market will determine the size of the interest rate cuts. And well, employment data of late has been quite weak from the US. Well, not alarmingly weak, but weak enough to actually keep the Fed those in charge of the market right now, especially after Jerome Powell's rather dovish speech of last Friday. Now in the market, the US 2-year yield died below the 4% level, the 10-year yield retreated below the 3.80%, and the US dollar index further dived on Friday. Now the yields and the US dollar are now waiting impatiently next week's jobs data update from the US, as the jobs data is gaining importance after a long focus on inflation. But before that, well, we will be watching the US GDP update, which will come this Thursday, and the core PC index, which is the Federal Reserve's favorite gauge of inflation, on Friday. Now, the US GDP is expected to have rebounded to 2.8% in the third quarter from 1.4% printed a quarter earlier. But Atlanta Fed's GDP Now index suggests that the third quarter growth in the US may be slower than that 2.8%, around 2% only when considering a bunch of fresh economic data that came in lately. So if that's the case, if the growth and inflation figures from the US hint at weakness in the US economy and further cooling in consumer prices, well, there will be no reason whatsoever for the Federal Reserve those to leave the playground. Right now, the expectation of a 50 basis rate cut from the Fed has been rising slowly but surely, and the risk assets are surfing on, well, that dovish vibe in the absence of major economic stress. So the S&P 500 and Nasdaq 100 extended gains on Friday by more than 1%, and the Russell 2000 index jumped more than 3% on Friday's trading session. But an economist at Bloomberg, or a journalist at Bloomberg, listed the big rate cuts from the Fed since 1980s and the impact on the S&P 500 3 months later, and came to the conclusion that a jumbo rate cut is indeed not great news for the stock appetite in all cases, as it actually comes in an environment of slowing growth and mounting stress. And well, in the 1980s, the market reaction to the big interest rate cuts were quite mixed, but since 2000, well, the S&P 500 reacted negatively to large size interest rate cuts. So I actually remain convinced that a 25 basis basis point cut from the Fed is the right dose of dovishness to help keep appetite intact in the stock markets in the absence of, well, big economic stress, and big economic stress would anyway not be good for the stock appetite. Now, besides the economic data, this week will be marked by the Nvidia earnings to close the dance for this earnings season. And well, because Nvidia has become the mascot of the AI release since last year, well, it has an important impact on market sentiment and also on the direction of the major US indices. Now, the earnings from Nvidia are due after the Wednesday's closing bell, and while the market expectations remain sky high. Now, the company has pointed at a whopping $28 billion worth of sales in the second quarter of this year when it released earnings last quarter, remember? So that's the double of the amount it made a year earlier, and the market's consensus is just a little bit more than that at around $28.7 billion of sales. Now, although the worries regarding the big technologies, big AI spending have been mounting since a while, as the AI investments haven't yet improved these companies who invested in these AI tools profits just yet, the big AI spenders like Meta and Google, for example, who account for around 40% of Nvidia's revenue, said that, well, they'd rather overspend on AI than underspend to make sure not to miss the decisive AI turn technology. Hence, I wouldn't really be surprised to see Nvidia do better than the market expectations this quarter around as well and announce just another blowout quarter. Yet it's sure that at the current valuations, so PE ratio is around 75 for Nvidia, well, Nvidia cannot afford any missteps. Everything from the numbers to the guidance should be just perfect to keep the rally going, and this is actually where the rising competition among chip makers and impatient investors who could just force the big spenders to spend less money on AI are, well, becoming growing challenges for Nvidia. But anyway, we will have to wait until Wednesday's US close to have more details on how Nvidia did and what Nvidia expects to do this and next quarter. Elsewhere, the US dollar's further dive on Friday pushed the euro dollar to 1.12 level on Friday's trading session, but the pair sees some resistance at this level in Asia this morning. And well, I actually still believe that the euro's recent surge is overdone against the US dollar, and a downside correction, at least a minor downside correction, would be healthy at the current levels. Now, this week, the Eurozone's economies will be releasing their preliminary CPI numbers for August, and the market expectations are weak, because the numbers will be, well, released throughout this week because, well, we have so many Eurozone countries, and the aggregate number for the Eurozone, the entire economy, is due on Friday this week, with the expectation that headline inflation in the Eurozone may have eased from 2.6 to 2.2%, whereas core inflation is still seen a bit sticky, slightly below the 3% mark. But inflation in the Eurozone also seems to be in check, as it is the case in the US, a situation that should actually allow the European Central Bank to continue cutting its interest rates as well. And the European economies likely need these interest rate cuts more than the US does, but the European Central Bank is expected to cut by 50 basis points before this year ends versus 100 basis point cut expected for the Federal Reserve. Hence, there is a growing room for a dovish adjustment in favor of the European Central Bank expectations, and that could weigh on the euro at the current levels. And finally, well, crude oil gained on Friday along with other risk assets, and oil bulls are joining in this morning on news that Israel has declared a 48-hour state of emergency after launching a preempting strike on Hezbollah sites in southern Lebanon in anticipation of a response to last month's assassination of its military chief. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.